Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark on whether the charge by gold and silver will continue. Kaiser Research founder John Kaiser explains why Canadian exchanges need a return to the Uptick rule. He also discusses naked shorting. We'll talk to Ross Clark right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to This Week in Money, Ross.
Always nice to be with you, Jim.
The precious metals in big play this week.
It's the metals themselves. This is really interesting here this year. We've had a sector which everyone had finally learned to hate, being down for the better part of 5 years, from 2011 right through until the December of 2015. And as it's turned on a dime here and pretty much gone up uninterrupted into the middle of March and gone into a consolidation phase, we've continued to see the speculative long positions grow in both in terms of the gold bullion price and in the silver positions as well. We now have commitment of traders numbers showing that the speculators are long the greatest number of contracts in gold since the top 2 weeks back in 2011. And the silver market also showed significant moves this week, up another 10,000 contracts on the speculators and an additional net short position on the commercials of about 14,000. And these are significant levels, and I think in particular when you look at it, because the metals prices, for all that they had the big action into the middle of March, have really been thrashing around a lot here. Gold is still stuck at the 1233 level, midpoint of where it's been. I'm continuing to view the 1210 and maybe up to 1215 level right now as the critical support. And if we see closes below that, I would expect that you would see fairly significant drops thereafter, just because we've built up such a position in terms of the speculators. And the last few times that we've seen this were they were drops that took the better part of a month and a half before things were cleaned out. Now, as I say, the catalyst point is that 1210 to 15. If it manages to hold above that, there could still be surprises to the upside.
Ross, what's happening with gold stocks?
Well, the precious metal stocks have, you've got a sector here that's pretty darn small when it comes to the world. You take a look at maybe $160 billion worth of the major gold stocks market cap when you put it together. Silver, you've got maybe $30 billion worth. To put that in perspective, the spider S&P, just on the S&P itself, is $190 billion. It's bigger than the silver and gold positions combined. You take a look at Apple. This is a quarter of the size of Apple. And the GDX, which would be the basket of ETFs for the mining stocks, I mean, that's only $6 billion in size. So being such a small market cap, when institutional players and the fund managers decide that they want to have a very small percentage of their portfolios now back into precious metals, it has a dramatic effect on the stocks. And here we've got gold bullion's up 23% this year. Silver price is up maybe 18%. But the senior silvers and the senior golds are up the better part of anywhere from 80 to 150%. So, recognize that, yes, we were very, very depressed in terms of the pricing of these stocks through the last year or so of the break. However, the percentage moves coming off the bottom at this point are such that I think we need to be pretty darn cautious in here. If we take a look at the ratio, you take a look at the ratio of some of these top silver stocks and the move relative to the silver price, and we do a relative strength of that, we find that those RSIs are now up in the 70 to 75 level. And this is very infrequent. You've actually got to go back to 2002 when silver was coming off the bottom at $5 to, in that initial surge off the bottom, that's where you saw high RSI numbers like this. And what we had shortly thereafter was corrections that were back to at least the 50-day moving averages, generally in the 20 to 40% bracket, not in terms of retracement, but actual price declines before you then got the next good legs to the upside. So I'm not saying that the precious metals are coming to an end in terms of the moves that can happen for these stocks. It's just that the speed at which the money has come into it, the sector here, there's going to be a lot of volatility as we move forward in the next few months. And don't be surprised if you see the stocks which have been outperforming bullion for a while here. They will probably have a 180-degree turn and see a good correction that gives back more than the bullion gives back.
In other words, you might want to wait for a bit because it looks like the sector is going to be strong for quite some time, but maybe not just yet.
Well, yeah, and so don't get too carried away. We're in a real speculative frenzy as far as some of these stocks are concerned, and I know it feels good if you're into them already. And I would just suggest that there's a point at which people might want to be looking to take some money off the table. Definitely a time to be thinking about having reasonably tight stops underneath if you're a trader of any means, and if you're a longer-term investor. I would suggest you take a look at waiting for a correction. For me, it would be either like the 20-week moving average or a 50-day moving average. And those are a fair amount below us right now because it's been a pretty dramatic move. But patience usually is a virtue when it comes to investing, and I think that you'll find, maybe even if it's the same price level, but if we've run and then pulled back, you'll probably have better risk control by waiting for a while.
Ross, are you going to be coming up with another gold chart for us in the near future?
I can definitely have one available for people. I would suggest by the middle of next week, if people send me an email at ross.clark@cibc.ca, we'll have something for them at that point.
Thanks for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark, investment advisor at CIBC Wood Gundy in Vancouver. Coming up, John Kaiser on This Week in Money.
Always consult your investment professional before making any investment decision. Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band coming to West Vancouver Friday, May 6th at the K-Meek Center. Buy online and save at ontourtickets.com. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is John Kaiser, founder of KaiserResearch.com. He's speaking to us from San Francisco. Welcome back to This Week in Money, John.
Jim, it's good to be back with you.
Let's explore ways to reinstate the Uptick rule in Canada and put an end to naked shorting on the junior markets. We're going to focus on the TSX Venture Exchange, but this will also apply to the Canadian Stock Exchange. Are there ways to put an end to naked shorting without reinstating the Uptick rule?
Now, first of all, naked shorting, people need to understand what that means. Naked shorting is when you sell stock without properly borrowing the stock so that you can deliver it within the 3-day settlement of the trade. And normally shorting is only allowed in a margin account set up specifically for shorting. And when you plan to short, you have to make arrangements that the firm that you are shorting through can indeed borrow the stock and make it available for delivery. When you do not do that, that's called naked short selling, and it's questionable to what extent this is actually a problem on the venture exchange, because borrowing shares for A venture company is not very easy. It can only be borrowed from accounts that, for example, are margin accounts or accounts which are cash accounts where the client has not paid any amounts owing within the 3-day settlement. So simply enforcing the borrowing requirements would be one way of getting rid of naked shorting. Now, that will not get rid of shorting, and shorting on a punitive manner that helps the stock prices go down, down, down in a venture capital market where relentless selling, even with properly borrowed stock, can be very damaging to the market as a price discovery mechanism.
Right. The whole idea of a stock market is to raise money, not to lose it, right?
That's right. It's to establish what is the fair price for the project, at what stage it is, and pulling in money to further the development of it. It's different from, say, a company that's already in production and that has earnings. Theoretically, there's a dividend that can be paid by such companies. In the case of a venture capital company like these Resource Juniors on the TSX Venture, there are no revenues, there are no earnings, so there is no valuation basis. They are all, in essence, bets on fundamental success being accomplished by the venture, and that always requires capital, usually through equity raises.
There are now 13 trading platforms in Canada, including the Venture Exchange. Could the Uptick rule be applied to each of the 13 platforms separately, and would arbitrage be an issue?
Well, the reason the Uptick rule was abolished was because the regulators allowed the alternative trading platforms to operate in parallel with, say, the order book of the TSX Venture Exchange, all in the name of competition. And so what brokers are now required to do, under the rule of getting the best fill for their client, they must submit an order through an algorithm that sniffs out all the different orders in these different parallel order books and run it so that the best fill is accomplished. And because this is being done simultaneously by many different parties, all with different goals and limits and so on, it is impossible to know as your order executes at different speeds whether or not the last trading price was indeed lower than the one that you are selling at. In other words, what the uptick rule is. So they abolished this precisely so that these alternative trading platforms can coexist in the system. And the original argument for them was that when you're dealing with markets such as options and index funds, ETFs, and so on, and also interlisted stocks, the traders hunting for the arbitrage need to be able to simultaneously sell and buy in these different markets, and cannot sit there and pay attention to whether it's on a downtick or an uptick. But in the case of Canada, it was the regulators saying, well, the TSX group has a virtual monopoly on this. They can gouge the public by charging all kinds of fees that they want for trade execution. So in the name of competition, we are going to require them to allow trading in their listed securities in these alternative platforms. And that also made the elimination of the uptick rule necessary.
Could all trades from the 13 platforms be funneled into a single order book run by the Venture Exchange?
No, I mean, that would defeat the whole purpose of that. An order book is basically a piling up of bids and offers, and then decisions made to push, say, a bid up to the offer level and take out whatever shares are in that queue waiting to be sold. To then have this happen in a separate platform and then push it through, say, the TSX Venture order book would be meaningless because the trade has already been executed. The ownership has been transferred, and it is now just a matter of clearing and settling the trade by delivery of the physical, or at least the digital securities into the swapping them from the respective accounts. So that's not an issue at all. It's the idea of orders that are parked in the system that create the depth of market. This is being done fragmented through, say, these 13 different platforms in parallel. It should all be in one order book, so that when an order is in there at, say, 10 o'clock in the morning, and then another one comes in at 10:01, when another order comes in to buy, say these offers, the earlier order gets filled first. That's the first come, first served principle, and that does not at all get honored by this system where the orders can randomly go through any of the order books. And it's usually done based on the type of pricing that the alternative trading platforms charge for the execution of the order.
You're listening to This Week in Money. We're speaking to John Kaiser, the founder of Kaiser Research. Roughly 90% of TSX venture stocks trading happens on the venture exchange, while 10% of trading is done through the other 12 platforms. Could the Uptick rule be easily reinstated if all venture stocks were traded exclusively through the venture exchange?
Yes, when you have a single order book, you can establish what the last different traded price was and whether this order that's tagged as a short sale is in compliance with the Uptick rule. It's ironic that the alternative trading platforms aren't really making a huge amount of money by being hooked up to the TSX Venture Exchange. They exist for the TSX exchange, where there are big companies with liquid markets and with structured products and all this kind of stuff. It should actually be considered to simply designate exchanges which are dedicated to venture capital listings that do not have these types of liquid markets for securities that can be properly valued on the basis of revenues and earnings, to be exempt from the requirement to allow hooking up the alternative trading platforms. This is an avenue that Canada should pursue in order to protect its venture listing ecosystem from being roadkill in something that isn't really benefiting anybody on a large scale.
Is that a big threat to the Canadian market?
I believe it is a threat in that because of all this, the loss of market confidence in the order execution system, the fact that entities can sell on a downtick if they so wish with impunity and not necessarily have to borrow the stock. I think it harms the exchange as a price discovery mechanism. It makes it difficult for companies to raise risk capital to push their ventures, and if the earlier stage investors do not see that they can get a better valuation when their project has been de-risked by the capital that they put up earlier, they become discouraged and don't put up any money in the first place. So it is in danger of just falling by the wayside and ceasing to be something that has always been sort of a trademark of Canada, especially in the resource sector.
Should shorting be banned for all stocks trading under $3 to $5?
I don't think short selling should ever be banned, because short selling helps when there's suddenly a buying frenzy due to some sort of momentum type of an impulse. It stops stocks from shooting way too high and harming the credibility of the market as a price discovery mechanism in the opposite direction, where the market ends up severely overpricing projects, and that's almost as bad as severely underpricing assets. It should simply be done properly with borrowed stock, and ideally with the something like an Uptick rule in place to prevent the relentless selling on the downside by parties that do not have even borrowed stocks in their possession.
How important is it for the structure of the market to reinstate the Uptick rule?
I do not think it is essential for it to be done. I think a bigger issue with the venture capital companies is the problem of enabling the public to understand what is a fair value for these securities. And we have relied far too much on the simple market activity to define that value. But it's turning out these days that with the onerous 43101 rules, which expressly forbid company executives from spelling out too clearly what their project is potentially worth until it is backed up by a 43101 report signed off by independent qualified professionals, the market has ended up at a loss as to, okay, this project that has a target of this size based on a geochemical anomaly and a geophysical anomaly now has one drill hole in it. What should it be valued at if you extrapolate the grades that you got with this first hole into the whole size of the target? And that is something that actually can be done, and it is something that I have started doing on a sort of test basis through my website, Kaiser Research Online. I call it outcome visualization, where you take initial information, you connect the dots, you imagine a deposit, you imagine a mine, and then you run the discounted cash flow model equation for it to see what it was potentially worth, and then you discount it again to the stage of the project. So something is potentially worth $1 billion and it's still just a target with maybe one hole into it. It should be worth maybe 5%, 10% of that $1 billion. Once people can see what it is that the market is expecting based on the fundamentals that the company has disclosed, then you can get a range, a fair value range for one of these ventures, resource ventures. And then when the short sellers come in there, and even when they're selling on a downtick, there will be other algo traders and value hunters who will see when the value approaches the lower limit, and they will come in and start buying. And so you'll end up getting trading volatility within a constrained valuation band. And then it would actually not matter that these entities are selling on a downtick with even unborrowed stock, because if they're caught going the wrong way when value hunters come in and then the company publishes an extra batch of holds that show that this is much bigger, well, then all those shorts are going to end up having to buy the stock at a substantially higher price and perhaps help it overshoot in value.
If the Uptick rule is not reinstated, would a bull market in resource juniors be followed by a market collapse?
Again, right now we are actually in the beginning stages of a turnaround for what has been a brutal 5.5-year bear market in the resource junior sector. And to some degree, it's being pushed by the fact that gold hasn't fallen back below $1,100 after rallying to a level of sort of $1,260, where it is at now, bouncing up and down $20 or so. There's a sense out there that the bear market is over. Gold hasn't made the kind of dramatic move that justifies a screaming bull market, but we are seeing a return of appetite for resource sector risk, both at the exploration level and in the more advanced companies, which are optionalities on, say, higher gold prices. If we did get, say, gold jumping $200-300, then you would probably see a tsunami of capital come in from the sidelines, and you would see the stocks go up considerably, and the shorts wouldn't really matter because they would get cremated. But at some point, the momentum of this would stall, and then we'll be back to the same situation where, as these juniors are trying to establish a fair value, given whatever the price that gold has settled out at and the fundamentals of the company's project, there will again be this pressure of selling stock on a downtick, which will harm the sector. And at the end of the day, it could collapse back to where it started, and the audience will walk away and say, this thing is just a big, giant pump and dump machine. It is not a price discovery mechanism that establishes proper value for these companies.
John, gold fever seems to be sweeping the markets. I wonder, why is there such a gap right now between the price of gold and the price of silver? Well,
silver is an industrial metal that has many uses. Historically, it has been linked to gold by a certain ratio, and that ratio now is much higher than it has historically been. It's like 80 for 1 right now, where some people say it should be 30 to 1, which means silver should be 2.5 times higher than it is. The real question is, why is gold trading where it is? Gold is useless. It is not used for anything. It is just accumulated and hoarded, and it costs money to have it sit there. And silver itself, it's a function of supply and demand by end users. A lot of it gets recycled, gets put back into the market. Silver is produced as a byproduct of zinc mines, of copper mines, even of gold mines, and the producers don't care what the price of silver is. They just recover it at the cheapest rate that they can, and then they sell it for whatever is out there. And silver just doesn't have the cachet of gold in terms of treating it as a long-term hedge against uncertainty or inflation or whatever other reason you might have for gold. So I think the delinkage between gold and silver, it's a long-term phenomenon. If gold goes high enough, we can maybe get a movement in silver as it tries to chase it. But there is no basis for any formal price relationship between gold and silver.
That's interesting because people try to tell you that there is.
Yeah, well, these people are ones that own silver and wish it were higher. If silver did go up to, say $50, they wouldn't be telling you, and gold dropped to $1,000, they wouldn't be telling you that silver needs to go down to be in the proper ratio with gold to silver.
Are other precious metals getting much talk right now?
Again, platinum and palladium, they really aren't that precious. I mean, how many times have you heard a woman really say that, oh, I would love a palladium or platinum bracelet or something like that? They are industrial minerals. And again, in the case of platinum and palladium, they undergo extensive recycling. And it's probably going to be worse going for platinum in the future as all these diesel cars get junked as in the wake of Volkswagen scandal and a public backlash against smelly diesel cars. So it's been a bit perplexing that despite all the problems in South Africa with production and so on, that platinum and palladium prices have been as weak as they are. But it's partly linked to relatively weak global economic growth and the fact that there is a lot of recycled platinum and palladium that keeps coming back into the system. And at the moment, there is no new innovative demand growth for platinum and silver. Maybe one day when hydrogen fuel cells take off, then the demand for it will go higher. But hydrogen fuel cells are not yet taking off.
And I would say with the reputation hydrogen has, people still have the image of the Zeppelin coming down in flames. They're not all that keen on hydrogen, are they?
Well, I think hydrogen in the fuel cell context where it's compressed does not have the problem. I think the real issue with hydrogen is where is your hydrogen fuel refueling station? In California, they've got several dozen of them planned, but they're few and far apart. So if you think electric car people have range anxiety, how about if you have a hydrogen fuel cell car? However, there's interesting stuff that could happen which could change that. For example, one of my favorite topics is scandium, and I was checking Google Scholar, and there was an article a couple years ago about a metal hydride product created, which is basically a bunch of pellets made of some material which has been doped with scandium, which allows hydrogen to absorb hydrogen at a greater density than is possible with compression, and with the catalyst of some sort, release it instantly. So if something like that could be commercialized, one could imagine gasoline truck equivalents filled with these briquettes that have been infused with hydrogen, going to every gas station where it's been retrofitted to include a hydrogen storage container, hook up to it, defuse it, push all the hydrogen into the thing and drive off and reload and go to the next one. That could be the kind of breakthrough that causes hydrogen fuel cell stations to pop up everywhere using existing infrastructure, not having to get new locations and get them permitted and set up for the hydrogen fueling station. That's a chicken and the egg problem for the hydrogen fuel cell that's begging for some sort of innovation on delivering hydrogen to these stations.
I also understand, too, making hydrogen uses a lot of electricity. People are saying, why not just put the electricity directly into the car?
Well, the problem is, how do you store the electricity in the car? And right now we've got a big lithium bubble going on because the current car batteries have lithium as a major component. However, the range that the cars can go is still fairly limited. But an even worse problem is the time it takes for these batteries to recharge. And yes, they're starting out with these Teslas, have these swapping things where you drive into a so-called gas station equivalent, and they yank out your battery and put in a recharged one. But that's not really a scalable option because these batteries are still fairly bulky, and you have to take the old one, and it's going to take 4 or 5 hours to recharge it. With your gasoline tanks, it takes all of 20 minutes for a tanker to refill those type of thing, and it takes 5 minutes to pump it into your fuel tank. So if with the hydrogen fuel cell, you would be able to fill your tank within 5 minutes, just like with gasoline. And the delivery of the hydrogen fuel to the station would also be a quick and simple matter, except that it isn't quite yet there. So, yeah, electric cars, it's the batteries that are the problem.
Speaking with John Kaiser, founder of Kaiser Research in San Francisco. John, crude oil, it looks like it's going to have a long, hard struggle. And, of course, we've talked about electric vehicles already. That could be the death knell, in the distance for crude. Or is it?
Well, the thing with crude is with the shale oil revolution, there's hundreds of years of potential, oil supply from places like the United States, provided oil is $60, $80 a barrel. And the market did get used to, gasoline prices at $3 to $4 a U.S. gallon. And the question is, though, this is a bit of a problem for the for the Middle East oil producers, which have dominated the oil supply market. And they realized that the United States in 2014 achieved first place as a global oil producer, which was an unheard of concept before. So they have embarked on a deliberate program to undermine the Canadian oil sand oil supply and the American shale oil supply, push the price below the level where it makes sense to develop these resources, and continue to dominate this market. And I think that's almost a no-win situation for them, because that sets up a longer-term problem. It encourages the car industry to continue to explore alternative ways of fueling their vehicles. And I think the situation it's unproductive to the Middle East. They should simply let the oil be high enough so that everybody can produce it, and then there is no concern about security of supply. And that would be a bigger threat to the development of alternative methods such as hydrogen fuel or battery-based electric cars as a transportation fuel.
Could there be enough solar, wind, and tidal generation to supplant the use of fossil fuels for making electricity?
I do not think that completely replace it. The intermittency is a problem. This is why one of the big frontiers is long-term battery storage technology. Is can you set up systems where when the wind blows all night or at times when you don't need it, can the energy generated be stored in a manner so that when it is needed, it can be delivered on demand? I think long-term things like nuclear energy are still going to be a major component of the electricity grid, and I'm concerned about coal as a long-term supplier, and it is the biggest carbon dioxide producer, and it is also a producer of a lot of other pollutants, which is not the case with natural gas. And in terms of natural gas, there's always the possibility of carbon sequestration, where whereby you capture the carbon dioxide and perhaps store it back in the ground so that you're not loading the atmosphere as great as you would otherwise.
Janet Yellen, the head of the Fed, has said the world's economy really depends a lot on China. Should we be depending on China, or should we be looking at other places to do business just because China may not be the best place to do it?
The world has created a unhealthy reliance on China's continued growth, and the initial growth was very much capital investment, expanding its production capacity, which ironically was at the expense of the production capacity of Western nations, which have higher emissions and labor costs than China has. But China is now reaching its own higher costs as it deals with its environmental issues, as labor becomes more unhappy about low wages and poor health and safety standards, and a very lousy social safety net, despite still being a communist country. I think what countries should be doing, such as the United States, is embarking on infrastructure renewal projects where they dump the austerity mentality and readopt fiscal stimulus methods, where the money that they borrow to build stuff is stuff that's there as a legacy, so that the younger generations who are stuck paying it off have some benefit for it. The world really needs to rebuild its own infrastructure and not just think that it's going to be dependent on the growing standards of living of China and eventually India as the engine for their own productivity.
The new Trudeau government's budget does say we're going to run deficits $30 billion a year for the next 5 years, and the idea is to stimulate the economy by doing things like putting in new rapid transit lines in places like Vancouver, where we have the busiest transit use in North America along one route, but it's done by buses, places, things like that. So is that a good investment then?
Yeah, anything that makes transportation more efficient is good, but also energy production is an excellent way to spend money on infrastructure. And of course, then there is the dealing with emissions. Making things less polluting is a way of reducing the down the road costs, health costs that come when you have pollutants in the air. And of course, it creates physical local jobs right away, as opposed to jobs that are performed in other countries, creating products that then end up being consumed in, say, the United States or Canada.
Yes, and another reason why some people have said using government borrowing right now is a good idea is interest rates are very low, so it's affordable.
Yeah, indeed. If you can lock in these low rates, why not do that? It makes a lot of sense. And I think when the next election is done in the United States, it'll be such a, big kerfuffle. I think they'll finally toss austerity out the window and get the American economy going with a huge infrastructure renewal program. And whatever other things that Donald Trump may be saying, if he ends up in charge, I don't think he has any problem with spending money on infrastructure. He may find that it's not so easy to reduce taxes to zero and ramp up spending. But I would suspect at the end of the day, he would lean towards fiscal stimulus for productive things like infrastructure as a way of getting the United States economy growing organically again, rather than limping along on low interest rates and sort of the quantitative easing type of stimulus.
Trump likes to threaten, we'll cut this off, we'll build a wall, we'll kick these people out, we won't talk to these people, we'll bomb those folks. He doesn't seem to be a very cooperative person when it comes to international affairs.
Well, Trump is pushing the so-called autarky policy because he understands that the American people feel pressured by what they've witnessed in the last 20 years, where the manufacturing base underwent tremendous job losses, and although manufacturing is coming back, it is coming back in an automated form that employs only a fraction of the people that it used to. So he's tapping into a sense that the enemy is out there, we need to circle the wagons, and he's appealing to the voters in that way. But his anti-protectionist stance is not really, I doubt that he actually believes it. It's a bargaining point where he can talk to other groups to make sure that trade is going both ways. In terms of trade imbalances, I doubt Trump would argue that fairness exists when China has very polluting standards and gets to subsidize its manufacturing costs by harming its own people, and that this is a fair way to deal with people in North America where there are rules. He could go the direction and say we need to get rid of the EPA and get rid of all these environmental rules and make things as cheap as in China, where people simply die early from getting sick from all the pollution and so on, and that would help take care of the longer term Medicare problem and Social Security problem by putting a limit to the longevity that is being enjoyed in North America right now.
Yes, one of the reasons I believe Japan's government has the tobacco monopoly is that they want you to die before you can collect your pension.
Yeah, except Japan has the highest longevity rates in the world.
Tied with BC, by the way. BC and Japan, second highest life expectancy. In BC, it's because we smoke a lot less than other people, we exercise more, and we have a great cancer agency that's been doing great work that's recognized around the world.
Well, British Columbia is one of the best places in the world, and it's no wonder that the people live longer than elsewhere where it's maybe not so great to be.
Hanging around for a long period of time. John, how can people find out more about Kaiser Research?
They go to kaiserresearch.com, and there's all kinds of links on the home page, and I suggest you look for one called Outcome Visualization to get an understanding of what I've been talking about in terms of a solution to this problem that we have of this short selling on a downtick, wrecking the market as a price discovery mechanism. I've developed a way to help people understand how to price early stage companies, and it's well worth their while to check it out and see how it gets done.
John, thanks a lot for being on This Week in Money.
Jim, it's been a pleasure.
My guest has been John Kaiser, founder of KaiserResearch.com. That wraps up our show for this week. We'd like to thank our guests, Ross Clark and John Kaiser, and thank you for listening. Comments or questions for the show can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.